So first of all, thanks to everybody for attending today. We realize that your time is important, and we are very happy that you're able to take this 45 minutes to an hour and hang with us and learn a little bit more about the CuChoice program that we're talking about. Again, my name is 𝗨𝗶𝗶𝗴𝗍. With us today also from ASI, we have Theresa Mason, our president and CEO, 𝗏𝗏, our COO, and then wrapping up today, we'll have Jennifer Kelly. She is our AVP of Advocacy. She'll be wrapping up the presentation later. We're also delighted to have on board with us today 𝗨𝗶𝗶𝗶𝗴 from Michigan First and 𝗏𝗏 Peters from Michigan Legacy, along with noted and famous economist Bill Hample. And lastly, we're also very happy to have with us some friends from the Michigan Credit Union League. Kieran, Haley, and Bradley, I think, are all with us here today. American Share Insurance has been providing primary deposit insurance to credit unions for over 50 years now. We were founded back in 1974 with the help of 𝗨𝘶 McCarran-Herring, the mother of credit unions, right here in Ohio. As we get ready to kick this off, I'm going to have Theresa jump in first. We heard this saying the other day, you don't know today what you might need tomorrow, and we really think that really summarizes private insurance. If you're in a state that doesn't have private insurance, you don't know what it is. But those states that do have it, the 10 that we work with, have found it to be incredibly valuable for them. So with that, I'm going to turn this over to Theresa.
Thanks, David. Hello, everyone. I'm Theresa Mason, President and CEO of ASI. So we are really excited to be able to share some information about private insurance with all of you. We live it every day, so we understand many of you don't, and we know who we are and what we do, but we really want to help everyone understand. So that really is part of the point of today. So we tend to be passionate about private deposit insurance and what it can offer state chartered credit unions and even to the federal charter. But just having that choice available can be of value to the system. So a little bit about us. We are an insurance company, and there is an overlap with the regulators. Both of us have the same primary goal, and that's safety and soundness in the credit union system. And managing risk really is our number one job. So what is the credit union choice? David, thank you. We believe having the choice is good for the credit unions in general, whether you are state chartered or federally chartered. Where there is choice in the system, there is opportunity for credit unions to choose and to choose a path that's right for their members. So there's a little misconception that when we enter a state that many credit unions will convert. And we know that's not usually the case. We aren't the right choice for everyone. But wouldn't it be nice if someday you do find yourself needing more from your insurer, that you have that choice? Think about more consideration of your membership needs, more understanding of the focus of your lending program, or just more appreciation of your unique mission. So that's really the opportunity that lies with private deposit insurance, whether you have that need today or not. And wouldn't you want that option to be available to your fellow credit unions? We do think so. So overall, why do we do this? So David, this really leans into our mission. Our mission is to empower credit unions and their unique mission. And we believe that making private deposit insurance available helps us do just that. We really do appreciate this opportunity to share with all of you today. I want to thank you for attending, and we look forward to working with all of you, the Michigan League, and the regulators in the state of Michigan. So let's get started.
Thank you, Theresa. Let's go ahead and move on to 𝗏𝗏, our SVP and COO, and talk a little bit about the collaboration we have with our credit unions. Kurt?
Thanks, David. I'm 𝗏𝗏, SVP and COO at American Share Insurance. One of the really good things about ASI is how we approach our interaction with not only the credit unions that we insure, but the regulators as well. We have a great partnership with the regulatory authorities in each of the 10 states where we offer private deposit insurance. And that really helps us to lean into serving as a business partner for the credit unions. We approach this as We are the insurer, not the regulator. In many cases, in a state like Michigan right now, where the only option is for NCUA as the insurer, a state chartered credit union will have your regulatory authority there in Michigan, but also have the NCUA serving as a secondary regulator. And so that's one of the things that with ASI, we approach this a little bit differently. We work with the regulator. We're looking at safety and soundness at all times, but we want to make sure that we're working with the credit unions to see what really helps you serve your members best. In a couple areas here that we think are great benefits, we insure the credit union deposits on a per account basis. So if a credit union has a member with a higher deposit amount, they can structure that so that each account is insured for $250,000. So whether that be a checking account, regular share, or multiple certificates of deposit, each of those are separately insured for $250,000. This allows a credit union to structure accounts so that they're fully insured and potentially higher account coverage than they could achieve through NCUA. In some cases, this is really beneficial because it allows credit unions to customize their approach with larger depositors, make them feel fully secured with the insurance side, and take that money and redeploy it into their mission of serving the communities that they're in. We're also try to be incredibly flexible with the credit unions we work with. We've realized that one size does not fit all. So we have credit unions that are faith-based lenders. We have credit unions that are ag lenders, those that serve underserved and low-income areas. And we understand that your needs at your credit union are going to be different than the needs of a credit union in your same state, but a different area. So whether that be geographic differences, field of membership differences, or just the areas that you serve and the types of memberships that you serve, those are going to vary from credit union to credit union. And through our flexibility, we try to work with the credit unions in understanding what your business model is and how we can best help you serve them. We try to work with our credit unions directly and making sure that we understand your needs, and so that we can help you best achieve success. As an insurer, as long as you are safe and sound, that is beneficial to the fund. And so we're working with not only each of the credit unions we insure, but as I mentioned, the regulators and the leagues as well, to help promote the overall competitive balance of the credit union industry in each of the states that we're in. We think that competition fosters improvement and success in each of the credit unions that in each of the states that we're working in. So those credit unions that have a choice are always striving to be more successful and, more importantly, serve their members in the best way possible. And so we want to look for opportunities to help you do that at your institutions. And as I mentioned, that with the account coverage being on a per account basis rather than just per member, we think that with greater coverage, you can reach out to higher balance depositors, bringing in all of their deposits at a single institution helps you form a better relationship with those members, becoming their primary financial institution, bringing all of their funds into a single place, and really having an impact for them and for you as an institution, and pushing that down into the entire communities that you serve.
Thanks, Kurt. Next up, we have 𝗦𝘁𝗶𝗶𝗶𝗴. She's the president and CEO of Michigan First Credit Union. I'm sure a lot of you folks know her already. She has the unique distinction of having worked at a credit union here in Ohio that was privately insured, and seeing how ASI worked with that credit union during her time there. So, Jennifer, take it away.
Thank you, David. Hi, everyone. It's a pleasure to speak with all of you today. Again, my name is 𝗨𝗶𝗶𝗶𝗴. I'm privileged to serve as president and CEO of Michigan First Credit Union. I have been here now almost 7 years, but prior to that, as David alluded to, I worked and served as president and CEO of an Ohio-based credit union. And shortly during my time there, prior to going into the CEO role, I realized that the credit union was not doing very well. We were struggling quite a bit. Eventually the CEO was no longer there and I was asked to fill the role. Everything moved pretty quickly during that time. And I was in one of those positions where I didn't know what I didn't know because I wasn't too familiar with the credit union space. And unfortunately, at that point, the credit union was about 5% net worth. Probably lost about $3.5 million in 3 years. I think liquidity was around 1%. It was a really tough go. It required quite a bit from the team for us to be able to turn the credit union around. And during that time, we worked very closely with ODFI, the state regulators, as well as ASI. I think I had Kurt Louse on speed dial during that time, and I'm excited to share some of those experiences because it takes a lot to turn around a credit union that is struggling at that badly. And what it takes is a lot of resources and a lot of guidance and a lot of help. And I had that with ASI. Our team had the support. It was a very good partnership. When you're going through something like that, you work around the clock. I still remember days where you're working at 8 in the morning until 9 at night, just trying to make sure you're sleeping enough hours. And Kurt was a phone call away from me. I can truly say that. And, he wants to make sure, ASI wants to make sure we're sound and safe as an organization. But, they're kind of cheering for us along the way. And I felt that. And we saw that as we worked through that. There was a lot of structure that was needed for us to turn that around. So the guidance was there to put that in place. A net worth restoration plan was needed, a profitability restoration plan, a branch profitability plan, a liquidity management plan. None of these things were in place to point us to the right direction. So we quickly had to do that. And the other thing that was critical was I needed resources available to me, people to talk to understand and learn as quickly as possible. So again, here ASI came through for me and pointed me in the right direction and provided a number of different resources. The other thing is when you're stuck in a situation like this, it's critical that you move as fast as possible and as quickly as possible. And you need partners that can do that along the way. And I can say with 100% confidence that ASI as well as ODFI worked very quickly with us to be able to make the changes that we needed to make. I would say within a year, we increased net worth by 2%. After again losing $3.5 million in 3 years, we were over 1% ROA within the year, and we were even able to be awarded a CDFI grant, which if you know about CDFI grants, you have to show that you have the safety and soundness and the financial backing to be able to do that. And so it was a huge accomplishment for the team, but also a big thank you to ASI and ODFI, quite frankly, because there were a lot of us working together hand in hand to be able to turn that around. So again, thank you very much for the opportunity to share the story. We're here to be able to just talk about the option to be able to offer private insurance to the state of Michigan credit unions. Thank you.
Thanks, Jennifer. If you have any questions for Jennifer on the side, I'm sure she'd be happy to. I'm volunteering you, Jennifer. Sorry. We'd be happy
absolutely.
to take any questions or anything else you have at a later date as well. Up next, hi, Karma. We're welcoming Karma Peters, President and CEO of Michigan Legacy, overcoming IT issues as we all do every day practically to be here. So thank you. And she's here to talk about the importance of the state charter and how this could assist with that. Karma, it's all you.
Absolutely. I was introduced many years ago by a mentor, 𝗏𝗶𝗵𝗶𝗴, about private insurance. Since then, we are a state chartered credit union in Michigan. I have many colleagues and peers in the Ohio market, and one in particular that has had state our alternative ASI insurance for many years, and he cannot say enough good things about it. I firmly believe, as you have all stated very well earlier, that the credit union should have a choice, and that we should be able to look at that alternative to our regular NCUA insurance. I don't know about many of you, but after the recapitalization, I did not receive all my funds, and I've never seen a dividend on my funds that are with NCUA. So I just think it's an important alternative, and I think the credit union should have the ability to evaluate that, make that choice, and then determine if it's right for them.
Thank you, Karma. Again, thank you very much. And if you have any questions for Karma offline, I'm sure she'd be happy to help out with those as well. If you've heard Bill Hampel speak before, you know how much fun this is on a generally speaking. Mr. Hampel, if you would, please.
Mr. 𝗨𝗶𝗶𝗵𝗶, thank you. Okay, hello everyone. Thanks for the invitation. Good to see you all. Well, I don't see you. I guess good to be heard by you all. It's the appropriate way to say it. Here's my agenda for what I'm going to talk about. First of all is the advantages of charter options, and by that I mean state versus federal charter, both for credit unions and also for the broader credit union system itself. A little bit about the connection between American Share Insurance and dual chartering. And then finally, the strength of American Share Insurance, how its past performance, how it has achieved that performance, and then a little bit about its current edition. There are several states have a document similar to this. And I would encourage you, I invite you to take a look at this. This is produced by the Michigan regulator. It's advantages of the Michigan State Charter. And this document is available from NCUSIF, which is the National Association of State Credit Union Supervisors, or I'm sure you can get it from the Michigan Department. This is a very useful document explaining in the context of Michigan itself the advantages of a state charter. I've summarized some of what's in that document and also just some other information that I have. Here's the advantages of a state charter in Michigan. First of all, you have local regulation and supervision. The examiner who comes to see you is a local person who's aware of what's going on in the Michigan economy and in other state charter credit unions in Michigan. You have access to policymakers. And there are kind of two times you want this. Let's say you have an exam where you have a disagreement or an area of contention with the examiner. In Michigan, if you want to, let's say, just to put this indelicately, go over the head or appeal or talk to someone with greater authority about what happened in your exam, you just have to go to Lansing. If you are a federally insured credit union or a federally chartered credit union, if you have an issue with your examiner, you have to go to the head office of the eastern region of the NCUA. And I looked up the address of the headquarters of the eastern region of the NCUA, and it's 1775 Duke Street in Alexandria, Virginia. Now, if you look up the headquarters of NCUA itself, it's 1775 Duke Street in Alexandria, Virginia. And back before I retired from CUNA, I rode a bike to work every day, and I would ride down Duke Street right next to that office. And so it's within biking distance of Washington, D.C., so it's not that close to Michigan. And also, probably more seriously, if you and your fellow credit unions want to get something changed about the rules, the law governing credit unions, you want to get more incidental powers or things like that, you have local access to those policymakers. You have greater investment authorities for a Michigan State Chartered Credit Union. You can invest in corporate securities as well as government and agency securities. You have really significant field of membership advantages. The federal credit union field of membership says you have to be either occupational or residential. In Michigan, you can combine those, which is very powerful. You have more incidental powers, greater ability to do some additional things that federal credit unions might not be able to. Very important, you have lower operating fees each year that you pay to to your state or federal examiners. You have greater access to CUSO-related services. There's some things that CUSOs can do there, or you can offer through a CUSO that a federal credit union can't. Savings and loan participation raffles. Michigan was one of the pioneer states in getting the authority for credit unions to offer savings or loan participation raffles not available elsewhere. You don't have to have a supervisory committee, and just in general, having a state charter is more conducive to innovation. And in a broader sense, this is an example of why having a dual chartering system helps not only the credit unions in the state where there's an option of a state versus a federal charter, but it helps the credit unions all over the country. And in fact, it helps the financial system because it allows regulatory innovation to happen in a state where a big national regulator like the NCUA probably wouldn't be willing to try some wild and crazy things, but an individual state might. If it doesn't work out, they shut it down and don't do it anymore. If it does work out, then the rest of the states and the federals can adopt it. I think savings and loan participation raffles are a perfect example of that. So those are generally the examples of the advantages of a Michigan charter and also more generally of a state charter. So if there are advantages to having the option of a state charter, having the further option of private share insurance puts that choice on steroids. It enhances and empowers the state charters. And the reason for this is that we have to remember that federal share insurance brings with it federal supervision and regulation. Back when I was teaching money and banking, one of the things we would say is this is for the banking system, that basically all banks in the US are subject to federal regulation. If they're national banks, it's a control of the currency. If they're Federal Reserve member banks, it's by the Federal Reserve. And if they're state chartered non-Fed members, it's by the FDIC. Well, it's the same thing for credit unions. If you are federally insured, you're subject to federal regulation and supervision from the NCUA. It's just part and parcel of what comes with federal share insurance. And frankly, some of the rules that you have to abide by as a federally insured state chartered credit union go quite far beyond what are pure insurance related safety and soundness matters. Very significantly, federal insured state credit unions are subject to 2 sources of examination. And these can be either 2 separate exams or a single exam, which is a joint exam. And those would, of course, be by the Michigan Department of Insurance and Financial Services and the NCUA. Back when I was at CUNA, we did a survey in conjunction with the leagues on exam issues. And the last major one of these was in 2013. This is a large survey. We had 1,500 credit unions responding. And one of the questions was, how satisfied were you with your last examination? And the choices range from 1, which means it stunk, we didn't like it, we hated it. And 5 was actually, it was quite useful. And so 3 would be the midpoint, neither really satisfied or neither really upset with it. Overall, across the entire sample, the 5-point scale was 3.5. The highest rated exams in terms of being helpful to the credit union were those exams conducted by a state supervisory authority only. Those were 3.7. Those exams conducted only by the NCUA received a score of 3.5. Quite significantly, the worst rated exams were those which were joint exams, which are 3.1. And of course, joint exams are ones that only happen for federally insured state chartered credit unions. Coming back to what we were talking about before, given that federal deposit insurance, federal share insurance exposes a credit union to federal regulation and examination and supervision, private share insurance basically insulates a credit union from that federal regulation and supervision, focusing just on what the state requires. And then in terms of how private share insurance enhances the dual chartering system, the proportion of credit unions with state charters actually is very different in those states that do or do not allow ASI insurance. So what this does is the line on the top is the proportion of state charters to total credit unions in a state. depending on whether or not it's an ASI state versus non-ASI state. I believe it was David or maybe Kurt said that ASI operates in 10 states. They do. They're really more prevalent in 7 of those states. In 3 of those states, they have just a small handful of credit unions. And so from my analysis here, I just looked at those 7 states that ASI has a significant presence. Back in 2000, on the left there, in those states which did not, in the 43 states which didn't permit ASI to operate, it's not so much they didn't permit them, but they didn't operate. In the 30 states where ASI didn't operate, 38% of credit unions had state charters, and by the year before last, we're in a new year now, aren't we? So I have to add a number to that. By the end of 2023, that number was down to 35.5%. The rest were all federal charters. But in those 7 states where ASI is active, there were 43% of credit unions back in 2000 had state charters, and that had increased to 47.5%. So, this is evidence that the state charter is more effective and is more attractive, and more credit unions choose a state charter in those states where ASI is active. Evidence that ASI is supporting the dual charter system. So that sounds great. You get more choice. You're governed and regulated locally. You don't have federal supervision. But the question any inquiring credit union should ask is, ASI a viable, dependable option? And there are some concerns that some have raised about ASI. First of all, that it doesn't have the resources that NCUA does. Second, it might have a tall tree problem. And the fact that aren't my members going to want federal deposit insurance? Are they going to accept not having federal deposit insurance? So let's go through a few slides and answer these questions. NCUA does indeed have far more resources than ASI does, but NCUA has significantly greater demands on those resources. ASI just has a single mission, which is share and deposit insurance. That's it, period. They have a Department of Examination and Insurance, which does which examines and runs the deposit insurance system, but that's their only mission. Their single mission is to provide deposit insurance to credit unions. We're single function. NCUA has that mission. It's the National Credit Insurance Fund, but also a lot of other things. In addition to examination insurance, it has an Office of Minority and Women Inclusion, an Office of Consumer Protection, an Office of Credit and Resources and Expansion, Business Innovation, Ethics Council, Ombudsman. Ombudsman is a good example there. An ombudsman is someone there when there's friction or pain points for insured credit unions, for that credit union to be able to reach out to the NCUA and start the process of finding out who in the bureaucracy might be able to help this credit union, or who in the bureaucracy might have done something that is making life difficult for this credit union, so they can see if they might be able to fix it. ASI has a single ombudsman, which is Teresa. If you're an ASI insured credit union, you have an issue with your deposit insurance, you pick up the phone and you call Teresa. And you go to the top of the chain, she will look into it, and you don't need an ombudsman for all the rest of the bureaucracy when the bureaucracy isn't that huge. And there's also the central liquidity facility too. So the NCUA does have more resources. It also has a lot more to do with those resources and a much larger and more unwieldy bureaucracy to have to deal with those. Okay, next one, Dave. So the next issue is the tall tree problem. Let's go to the next slide. The tall tree problem has to do with the fact that in any insurance company, if your largest insured risk is too large relative to the reserves or the funds that you have available to absorb losses, a loss at that one large risk could wipe out your fund. And so that's why insurance companies diversify. They insure over a broad range of institutions, or, this is for property and casualty insurance or anything. So in the context of credit unions, we think of the tall tree issue as how big are the loss absorbing funds of the insurance fund to the amount of insured shares in the largest credit union. And at ASI, if we take the insurance fund, which is the net worth, the retained earnings, and the contributed capital that ASI has, the net worth and reserves of ASI, and compare that to the largest insured credit unions insured shares at the end of 2023, it was 24%. It's like a quarter. And NCUA, it was 16.7%. So what that means is that the amount of a loss that could be absorbed at the largest insured credit union without exhausting the funds is 24% at ASI and 17% at NCUA. Flip these numbers upside down. What that also means is that the largest insured credit union, its shares at ASI are about 4 times the size of the fund. At NCUA, the largest insured credit union, we all know who it is 6 times the size of the fund. This is not to say that we should expect these sorts of losses and that these sort of losses are likely. This is just to sort of scale a catastrophe compared to what a large institution is. When credit unions fail, for small credit unions failing, it's typically because of fraud or investment at the credit union. And that can be a significant portion of the assets of the credit union. So you could have loss rates of 20% at say, a small credit union because of the former manager of the credit union who now lives in South America, having absconded with all the funds of the credit union. However, at a large institution, loss rates, first of all, large insured institutions hardly ever fail because they're so closely scrutinized. But when they do fail, the losses are much, much smaller than that, largely because they have really strong internal control processes, which kind of rule out any significant fraud. And, at a large institution, if a mid-level employee steals $100,000, that doesn't affect the institution the way that would happen at a small credit union. So I think a 5% loss at a very large institution would be amazingly large. And in that case, at ASI, a 5% loss at its largest institution would represent 21% of its loss absorbing capacity. And at NCUA, a 5% loss at its largest institution would be a 30% loss. So the message here is that there is no particular tall tree exposure at ASI compared to NCUA. In fact, NCUA's tall tree is slightly larger relative to the size of insurance fund than is the case at ASI. But neither of these is a significant issue. So, but don't members want federal deposit insurance? Are people going to deposit money in a credit union if it's not federally insured? This is asset growth by insurance type and asset size. So this is looking at the asset growth of ASI insured credit unions compared to the asset growth of federally insured state credit unions in those same 7 states. So this is apples to apples comparison. And indeed, one might say, well, how about deposit growth instead of asset growth? Well, for credit unions, your asset size is determined by your deposits. It's not determined by anything else. And so the size of the institution, unless you've got a severe liquidity crisis and you have to borrow money to make loans, the size of the institution is determined, especially over the long term, by deposit growth. And this is a 10-year period. The 10 years ending in 2023. So indeed, the federally insured state credit unions grew at 7.7% annually and 5.5%, 5.4% for these ASI insured credit unions. So that's smaller. And also by merger adjusted, what we mean, we've adjusted for the fact that if a credit union merges into a credit union during the year, we don't include the merged in assets as part of the growth during that year. So it's just an organic growth measure here. However, in those 7 states, at the beginning of the period, ASI insured credit unions tended to be smaller than the federally insured state charter credit union. It's primarily because a significant portion of this happens in California, and there are a lot of very large federally insured state charter credit unions in California. That's why they were over $500 million on average over these 10 years, compared to $200 million for the ASI insured credit unions. In those same states, by peer group, For those credit unions in the $100 to $250 million asset size range, their average growth during those 10 years was 4.8%. Credit unions in those states who were in the larger than $500 million asset size, their average annual growth rate was 6.5%. So the difference between the ASI and the federally insured growth is not because of the existence or not of federal versus ASI insurance. It's because the non-ASI insured credit unions, the federally insured credit unions, were larger, and larger credit unions grow faster than smaller credit unions. Now, there are a lot of other things going on, but there's a lot of evidence for a long time that, and I've heard this from CEOs who are CEOs of ASI insured credit unions, that far and away, for the most part, they don't have any difficulty attracting deposits because they have ASI insurance. Okay, so this again sounds great. We've sort of said these concerns don't need to hold us up, and so we kind of like the freedom to choose. But how reliable as an insurance option is ASI? In other words, down there on the bottom it says the power to protect. Does ASI actually have the power to protect? So let's take a peek at how well capitalized it is. This is a comparison of end of 2023, the capital positions of ASI and NCUA. And this is sort of an economist's version of this. This is not the way the audited financial statements would tell you, but I'll explain the difference here. The GAAP retained earnings are just what they say, the retained earnings. All of these numbers are divided by insured shares, by the total amount of insured shares. So these are sometimes called coverage ratios. It's the ratio of the capital or the equity or the net worth of the insurance company to the total amount of insured shares outstanding that it is insuring. And so for ASI, I've got 20 basis points, and for NCUA, 23 basis points. Actually, ASI's is 25 basis points. But I've adjusted that down to 20 for the following reason. ASI also has a excess insurance program for federally insured credit unions to insure deposits over the $250,000 limit. Kurt mentioned to you before that ASI insures per account, not per member, and so you can with ASI get coverage of more than $250,000 per name per person at a credit union. But for federally insured credit unions, you can't. And so federally insured credit unions, many of them buy a service from ASI to insure their accounts of more than $250,000. The ASI therefore has an exposure to losses at those credit unions. Now, the losses at those credit unions are really incredibly unlikely, because if there's a problem there, the NCUA is likely to arrange a merger to take care of it. But there is an exposure there. ASI has a reinsurance policy of $9 million to cover those losses. The reinsurance policy says the first $9 million of losses in an excess insured credit union are covered by ASI, and the reinsurance kicks in for the next $9 million. Anything beyond $18 million is covered by a separate capitalization deposits placed by those excess insurance using credit unions. Therefore, the maximum exposure that ASI could experience, that the capital of ASI for primary insurance could experience from secondary insurance, is $9 million. And so I subtracted $9 million from ASI's retained earnings, and therefore I went from 25 down to 20 basis points. There are unrealized gains and losses on investments. ASI's is 11 basis points and NCUA's is 7. The capital contributions at ASI are a bit higher than NCUA. It's 1.3% of insured shares versus 1. And therefore the total net worth, and this is net worth calculated the same way a credit union has to for prompt corrective action, which is taking retained earnings, but not subtracting out unrealized gains, unrealized losses, or adding back in unrealized gains. And so I've added back the 11 and the 7 basis points. So the net worth at ASI is 161 versus 130 in NCUA. On top of that, ASI and any insurance company has to hold reserves for losses, and they have to expense for these reserves for losses. This is like up until a couple of years ago, we used to have provision for loan loss expenses and an allowance for loan losses. We now have credit loss expenses, expense for credit loss, and an allowance for credit loss. That 14 basis points or the 1 basis point is essentially the same thing as the allowance for loan losses or the allowance for credit loss. ASI's is much higher than NCUA's, not because they have experienced or are expecting any higher credit losses. We'll see credit losses in just a minute. It's because they're subject to the rules of the Ohio Department, the Ohio government agency that governs insurance companies, and they're quite a bit stricter than what NCUA's has to follow. So that's basically available loss-absorbing capacity. Those are general reserves at ASI. Those are not specific for known problem credit unions. Those are just to sit there in case something happens in the future. So the total loss-absorbing capacity at ASI is 175. 1.75% of insured shares versus 131 for NCUA. So it's pretty well capitalized. What's the insurance loss history? So here, the green bars, unless I'm colorblind, I think those are green, are ASI, and the kind of the orangey reddish things are NCUA. This is from 2007 through 2003. And what we see here is that during the financial crisis itself, remember the big financial crisis of 2008 through 2010, ASI did have significantly greater insurance losses. And by the way, these insurance losses are not the provision expenses. These are not the accounting guesses that one has to have for anything that might happen in the future. These are actual cash losses for resolving failed or troubled credit unions that were incurred by ASI and by NCUA. And so ASI's were greater than NCUA's over the period. And I'm going to talk about that in just a minute for why. Just for context, the green and the orangey numbers are the same as we saw before for ASI and NCUA. Those blue bars, those are the losses that FDIC suffered during the financial crisis of 2008 to 2009. And this is just historically the case. I'll come back to this in a minute, that investor-owned institutions are much more willing to take on risk than cooperatives, and therefore when bad stuff happens, the cooperative funds have much lower losses than in the investor-owned ones. This is the reason why ASI had greater losses during the financial crisis. First of all, in the overall period from 2007 to 2023, that's 16, 17 years, the ASI's average losses were 2 basis points, NCUA's were 1 basis point. So they're both close to zero. During the financial crisis itself, ASI's losses were averaged 10 basis points for those 7 years, from 2007 to 12, and NCUA's were only 3 basis points. But then from 2013 to 2023, the following 10 years, ASI's losses were actually averaged negative 2 basis points, and NCUA's were zero. What happened then, and then again, this is not provision expenses being recovered through an allowance account. This is actual, the ASI was getting cash recoveries from selling assets at a greater value than when they acquired them, or insurance claims or bond claims. So ASI was actually getting back some of the cash that they paid out in cash during the crisis itself. So that therefore, over the entire period from 2007 to 2023, ASI's and NCUA's losses are pretty much the same as each other. Now, why were ASI's losses so much greater from 2007 to 2012? Well, it's because their exposure to the sand states. Sand states are Nevada, Florida, Arizona, and California. Those are the 4 states that were most severely affected by the financial crisis of 2008 to 2012. And what I'm showing there is that 45% of ASI's insured shares were in 2 of those sand states, in Nevada and California. They don't serve Florida and Arizona. At NCUA, adding Nevada and California, but also adding in Florida and Arizona because they work there, only 23% of their insured shares are in their 4 states. And so ASI was much more exposed to the problem areas of the economy, and that explains their greater losses, and yet they came through. In fact, I'll just be frank with you, it was, as a credit union analyst, I always was wondering, how would ASI do in a real crunch? And the fact that ASI, with almost 50% of its insured shares in California and Nevada, just before the great financial crisis, which was caused by the collapse of the residential real estate finance market, that the ASI worked through that. And I'm sure Kurt was very, very busy on the phone, just as Jennifer was telling us. They got through it, and they are in really solid shape as a result of that. So I think how ASI managed through the sand states during this period is really testament to their staying power. How does ASI do this? How can they be so strong and stable? First of all, they only insure credit unions, and I showed you a minute ago, credit unions are much less risky than banks. The second one is that ASI does not have to accept any credit union applying for insurance. And the fact that they can turn down a credit union or discourage a credit union from even applying means they can keep new risks, high risks, from entering the insurance pool, which protects credit unions already in the system. They monitor and examine their insured credit unions. And also, by operating in more than one state, they have geographical diversification. And also, there used to be several private insurance companies, each limited to an individual state. And in many cases, that meant that the state supervisor required them to insure all credit unions, so they couldn't underwrite them. And also, it created the idea that the state was going to back up these funds, which it didn't. So these are basically the reasons why ASI, as an independent multi-state organization, has been so successful. The dual chartering system benefits credit unions, heavily credit unions in the state where it has the dual charter, but also the broader financial system itself. The availability of American insurance strengthens the state charter option. If the option of a state charter is not only do you get to be regulated and operate under the rules of your state for field of membership and that sort of stuff, but also on top of that, you don't have to be examined by the NCUA. That makes the choice a lot stronger because of the existence of ASI. And then finally, ASI has performed well in good times and in bad, and is well capitalized. I believe is my last slide.
Thank you, Bill. I didn't see any questions come in through the chat, but if you do have any, Bill's always open to having discussions after the fact. We'll have his email and be able to send that out when we send some of the rest of the stuff out later on. So we'll have that too. We have a few words here with Jennifer Kelly, ASI's AVP of Advocacy.
Hello, everyone. Thanks so much for joining today. You would think by now I would learn never to follow an economist, but here I am. So I know we're right on time, so I'll try to keep this brief. And I thank everybody again for joining today. We really appreciate it. I just wanted to add on to the conversation to the chat earlier about kind of one of the concerns and some of the concerns we see from policymakers and regulators. And one of them that we often hear, or there's a little bit of fear in new states of a mass exodus of private insurance if a state all of a sudden allows it. And in reality, that's just not really the case. Across both of our established and some of our newer states, we see credit unions make the switch on a slower and more thoughtful basis. Private insurance is not a fit for everybody, and we work closely with those credit unions and their regulators to make sure it's the right decision if and when they want to make the move. As we wrap up today, I do want to make a few resources that are going to be available to you and discuss them with you. We'll be sending these out, so you'll have access to them, but we have a one-on-one frequently asked questions that I think would be really helpful for credit unions to understand and to also talk with your policy or legislators if this conversation comes up. Second, we also have an advocacy one-pager that, again, I think will be really helpful in kind of explaining our mission, how we work, and why it's really valuable for credit unions and policymakers to allow this in their states. I do have two key asks for you today. The first one, this is the easy one, is to please go ahead and sign our petition if you don't mind. We would love to have your support for just giving Michigan the choice and credit unions the options of private insurance. the only place we'd be sharing that is really with the regulator, just to show that there is interest, and the choice option for credit unions in Michigan is something that would be valuable for the regulator to look at. And secondly, kind of following that is, please, if you would like to and you feel comfortable, we would love for you to bring up private insurance with your conversations with your state regulator. Just let them know that you're interested in this option and you would like to, maybe allow for Michigan to have the choice. This will be a legislative change. We've kind of been connecting with the league, and there's potential that we're going to look at legislation starting this year, and hopefully we'll get something passed by 2026. We know how politics works. Things take time, but we are looking at making that legislative change, and we've had some preliminary conversations with your state regulator already, and we're beginning those conversations, and there's some interest there, but we still have to make sure that all policymakers and regulators are educated on who we are and what benefits we provide. So I'll just close with, at the end of the day, this is not about replacing federal insurance. It is about providing an option for credit unions to better serve their members. By introducing a choice, the state of Michigan or Michigan credit unions have a new kind of flexibility they can have and use while maintaining a strength of the overall system, and it's great for the state charter. So, and lastly, I'll just add, we will also be a GAC, and I believe we are attending the Michigan event on Sunday night. So if there's any questions there, or would like to connect with anybody on our team, we'd be happy to do so.
We're going to go ahead and wrap it up. Thank you, everybody, for attending. Thank you, Jennifer and Karma, for helping out with this. Thank you to our friends from the Michigan League for their attendance as well. We'll be getting the video out. Those documents that Jennifer mentioned, they will be linked in the presentation when we send it to you, so you'll have access to those. But otherwise, everybody, thank you so very much. We'll see you in the future. Please reach out if you have any questions. We'll be happy to help. Thanks again. Bye-bye.